In this week's recording, we're going to continue on with the question 5 in the question pack, looking at bin limited statement of cash flows. So remember, in the live webinar in week 2, we calculated the final answer, the movement in cash and cash equivalents, which we said was a positive 64,000. And we also set up a template, and we started to look then at cash from operations using the indirect method. So we're going to come down to working 1. We've this set up already, and we're ready for the thousands, so everyone will know that we're summarizing it, and go to the indirect method. So remember your indirect method, if you want to start, you're going to starting point, you can start with profit for the year, but you're going to be adding back tax, taking out interest received and paid, because these are all P&L items, they are not cash flow items. So I often start with operating profit. We're going to start there with 350. Now there's nothing stopping you starting with profit for the year and then adding back or taking away as you need. But essentially all of those 3 items, interest received, interest paid, and income tax, they are expenses incurred or income earned. They're not necessarily income received or expenses paid. And there's a distinction there when we're looking at the statement of cash flows. So the easiest thing is to start with operating profit, profit before interest and tax. We then deal with what we call non-cash adjustments. So remember, as we've done before, certain items in the profit or loss statement are non-cash, and they need to be adjusted because if we're reconciling between profit and cash flow, we need to make sure we've stripped them out. So it's not obvious from here if there's any non-cash items in there, so that's why we always go to the notes of the account and see what it tells us. So here, the proceeds of the sale of non-current asset investments amount to 30,000. All right. So you sold non-current asset investments of 30,000. Fixtures and fittings with an original cost of 85 and a net book value of 45 were sold at 32 during the year. So there's a couple of things going on here. So it had a net book value of 45 and they were sold for 32. So there's actually a loss on disposal there. And that's coming from note 2. And that loss on disposal is 13. You add it back. It is 45 minus 32. So it was sold for 32. They actually gave you the disposal proceeds when the net book value was 45. So that actually can be slotted into investing activity straight away if you wanted to. That's your disposal proceeds. Sometimes they tell you what the profit or loss is, and you need to work out the proceeds. Here they tell you what the proceeds are. You need to work out the profit or loss on disposal. So in that operating profit of 350, you would have had a loss on disposal of 13, which you need to take away. Right, that's your first key one. Then we're told there's more information about tangible non-current assets. You're told shares were issued during the year. We'll deal with that. You're told wages charged 90,000 of 5,000 were unpaid at the year end. So that's telling you that there is an accrual for wages at the year end. And you're told dividends of 100,000 were debited to equity, but they were included in current liabilities then as well. And you'll see that up there, dividends proposed. So the only other thing we need to watch for here is part A. The proceeds of non-current asset investments amount to 30,000. So if we go back up here, non-current asset investments in 2013, last year were 25, you sold it for 30. So there's a profit on disposal there, which is note 1, and you do minus 5. Now the reason you're doing minus 5 there is you would have recorded a profit when you sold it this year. So when you sell it this year, you would have debited bank 30, credited investments 25, and you would have credited the P&L 5. So in there, in that operating profit, is a non-cash adjustment of 5 because you sold it for 30. Now what a lot of students will do now is they'll take that proceeds, disposal of investments, and here, disposal of fixtures and fittings, and slot them into investing activities because you have them done already. That's why I set the template up. So here, disposal of F&F, and that is going to be 32,000. And you have disposal, spell it right, it'd be handy, of investments, and you're going to put in 30. So both of those would have been debit bank when you're selling the particular asset. Right, so you're disposing of investments, 30, disposing of fixtures and fittings, 32. Right, so that's why I set them up, slot them in as you get them. And you're getting there, that is note 1, and that is note, so that's note 1, and this is note 2. Just so you're showing the examiner where they're coming from. Or if you want to call it there, I think they may have note B and note A. So showing the examiner, that's given directly in the question. So you can figure that out. The 5,000 here, that profit on disposal is 30 minus the 25. You sold the investments for 30 this year. They were actually in the accounts last year at 25. So you must have recognized the profit on disposal when recognizing that disposal. So again, that's tricky enough as you're going through. The other obvious one that we don't seem to have mentioned here is depreciation. Right? There's always going to be a non-cash adjustment for depreciation. It's important for you then to be able to figure out where it is. And we're going to do here working 2 to figure out what depreciation is. So they don't tell us directly what it is, but they do tell us the property, plant and equipment here, the 305 and the 380. When you come down along, they break that 380 and 305 down and they give us accumulated depreciation. So we can actually use that to figure out what depreciation is. So working 2, depreciation. And the way you do this, the easiest thing is to set up a T account. Set up a T account, we'll underline it. Accumulated depreciation. And we'll put this here. So it's important, particularly at the start when you're doing these, you don't be afraid to use T accounts. It will slow you down a small bit, but it'll make sure you don't make any silly mistakes. So the balance brought down in accumulated depreciation is 290, and the balance carried down at the end of the year is 340. This is for all tangible non-current assets. There's only 2 things that change or move accumulated depreciation during the year, and that is charging depreciation for the year, which is debit depreciation, credit, accumulated depreciation, or disposal. So in this case here, if we look back, we had a disposal, right? The disposal happened fixtures and fittings. It originally cost 85 and it had a net book value of 45. So accumulated depreciation at disposal must have been 85 minus 45, which is 40. See the way you have to use the figures to what you want. You sold something at 85. So the debit and credit there would have been credit PP cost 85. It would have been debit accumulated depreciation, PP, 40, which gives you your net book value of 45. And then you would have had debit bank, 32, and you would debit the SOPL, 13. That's where the adjustments are coming from. If you know your debits and credits, we adjusted this loss as a non-cash item, added it back. We adjusted the bank, the 32, by putting it in, disposal of F&F, and we're going to adjust the accumulated depreciation by putting the 40 here. So this side is 380. This side should be 380 as well, the higher on both sides. So the difference there must have been depreciation charge for the year, which was 90. And that's the figure that will be in the P&L and that we need to adjust for. So it's like solving a puzzle. You use the information that you have to try and work it back. We're trying to figure out depreciation and we use accumulated depreciation for that. So we've done with all these and we slot it in. So you come back up here, working 2, and that's plus 90. You add back depreciation because it's a non-cash expense. And they're tricky. It's important to go back and have a look at those in your own time so you understand where it's coming from. So we add all those together and we say after that adjustment, it's now 448. The next step, what you do then, is you do your working capital. Working capital. Inventory, trade receivables, and trade payables. We'll do these as separate working. We'll look at working 4. So show the examiner just nice and neatly laid out and easy to follow. Sorry, working 3. So working 3 then, we're going to look at inventory, trade receivables, and trade payables. And what you're looking at is you're looking at the opening balance and the closing balance. And that will give you a movement. So all you're taking is the line items, you're looking at the line items in the statement of financial position, 102, 150, trade receivables, 315, 390, and trade payables, which are 119 and 127. This is a nice easy way when you're doing it the indirect method. It's a nice easy approach to have a look at. Just tidy up these to make sure that they're line them up. So the movement here is 48. The movement here is 75. And the movement here is 8. So you're trying to look at each of those now. And you're getting an idea of what's going on. Just double check here. Trade receivables 315, 390, 112. That's perfect so far. So let's have a look then and take an idea of, well, has that a positive or negative impact overall on each of the items in terms of cash flow? So the statement of cash flow impact. Well, an increase in inventory, that is negative. So minus V is negative impact when you're dealing with cash flows. It's a drain on cash because you have more money tied up. Likewise, this is a drain on cash, an increase in trade receivables. Both of those are going to be negative figures. So it's one thing calculating the movement. It's another thing then figuring out is that positive or negative. Trade receivables are the opposite of trade payables. This will be a positive impact because trade payables are increasing, which means you don't have to pay your suppliers as quick, which is positive for your cash flow. So it's minus 48, minus 75, plus 8. So minus 48, minus 75, plus 8. And you're doing that running total again. So that's important that you understand exactly where those figures are coming from. All right, so you're now at 333 as an approach. And that's the figure cash generated from operations is your 333. And you can slot it in. So often a big fan of using the indirect method. It's the easier one to approach. You can of course do the direct method, and I've given to you that in the solution. You come back and have a look at it. At the back of the solution, I'll show you the direct method, which will also get you to that 333. So 333, if we slot that in up here, and we're just saying working one. So you don't have to give any more detail, it's working one, and we have 3 other items to put in. We have interest received, interest paid, and tax paid, and we're going to deal with them. The reason I did them separately is they don't differ. These 3 items are going to be the same, regardless whether you do the direct or indirect method. So you can leave them separately and do them separate. The tax perspective, we're going to look at working 4. You're told here there's a tax liability at the start and at the end of the year, and you also have a tax expense during the year. Very similar to what we've covered in class. So a lot of these can be done quite quickly and get your marks on the board. So we'll bring down this and we'll do working 4, tax. Copy it again, apologies. So your balance brought down on tax. The opening balance in the tax liability was 110. The statement of profit and loss for the year. Look at it here. Statement of profit and loss was 140. So that means if we paid no tax, we should have owed 250 at the end of the year. What we owed at the start of the year, plus what we incurred during the year. However, the balance carried down at the end of the year here was we only owed 120. So how do we go from owing 110 to 120? We must have paid bank, this is the tax account, bank of 130. And that's the one you're looking for. It was credit bank, debit tax liability. So even though you had a P&L of 140, you only paid 130 because you owe 10 extra now compared to the start of the year. And you slot that in, minus 130, tax paid during the year. So there's a nice bit of repetition in a lot of these workings if you put the practice in. So come back up here Tax paid, working 4 minus 130. I'll just tidy these up so they're all in red as well, just for presentation. Interest paid, let's have a look at this. We know there's interest here paid 75 in the P&L, but if we look in the statement of financial position, there's actually no interest liability to start at the end of the year. So that must mean any interest we incurred during the year, we paid. So all I put there is SOPL minus 75. So the expense is actually the amount paid as well. And the only time that happens is when there's no opening or closing amount owed. And in that case, we can't see any in the statement of profit and loss. So therefore, we just use the minus 75. It's a bit of an easier one. Same with interest received. There's no amount of interest receivable at the start or end of the year. So whatever interest you earned during the year, the 25, it must have been debit bank, credit interest received. So you just put in there 25. And that is your cash flow from operating activities. 153. Net cash flow from operating activities. Please note you can do this figure 333 using the direct method as well, and the full solution to that is available at the end. Most students will use the indirect method. I will not mandate one or the other in an exam. You can use either. So whichever one you're happy with, please do stick with that. So that's 153. So if you come back to our steps that we suggest you go through, you set up the template we've done, and you start with the cash flow from operating activities. We've done that. When you're finished with that, then it's about working off the statement of financial position. So once you've the cash flow from operating activities, as we have here, you go back to the statement of financial position and you see which you haven't explained. So I will tick off each item as I've explained it. So I've explained inventories and receivables, short-term investments and cash. All of these are done already. These were in the working capital adjustments. These were calculating the final answer. So I'm finished with them, no problem. I've already explained trade payables, bank overdraft and taxation. So I highlight those. I haven't fully explained PPE yet. I've only explained accumulated depreciation. So I have to get to that again. So what you do now in your next step is you go through each line methodically, explain the difference, put it in the statement of cash flows. And ideally, if you've all of those in yellow, all of those line items explained, you'll have a correct answer. And the answer will come to the 64 that you had initially calculated. So let's look at PP. We have explained PP accumulated depreciation. We haven't explained PP cost. So this will help us determine what is the acquisition of PPE at the start of the year, or during the year, should I say. So we're going to look at here, working 5. PPE cost. So in some questions, like we looked at in class, you'll get PP net book value. Here, they split PP cost net book value out separately. So PP cost then, you have your balance brought down, was 595, but that has now gone up to balance carry down, which is a balance of 720. So we want to explain how do we get from an opening balance of 595 to a closing balance of 720. There's only two things that can move your PP cost account: acquisitions and disposals. So if you look at here, we know we did a disposal. So if you remember back, that's why it's always useful to think about the debits and credits. Remember the debits and credits we did for the disposal? Debit accumulated depreciation, we did that. Debit bank, we put that in the statement of cash flows. Debit the P&L, we put that in as a non-cash adjustment. What we didn't put anywhere yet, credit PP cost 85. So that's the 85, removing the cost of the asset sold, like you would do in a normal IAS 16 adjustment. So this side then is 805. To balance it up, you must have acquired assets during the year, which is bank 805 minus 595, 210. So you must have acquired assets at 210 during the year. Debit property, plant and equipment, credit bank. Now I'm actually missing something here. This gives you a good idea of where you need to be careful, because I've forgotten about reval reserve. My reval reserve has gone up, so actually revaluation here is 9, so my bank is only 201. So you have to watch for that. Even I got caught out there. I forgot to look for the reval reserve. If I have revalued assets during the year, that means it would have been debit PP cost 9 and credit reval reserve. Now I know you might say, well, surely that impacts accumulated depreciation as well. Again, we assume the ease that it just impacts PP cost unless told otherwise. So in the statement of cash flow questions, if you're given a revaluation, assume it impacts the cost only. So 9 of that increase from 595 to 720 is actually because an asset was revalued. That's nothing to do with cash flows. So the bank there is 201. That is debit PP, credit bank. And we come back up there. That is working 5. Acquisition of PPE, working 5 minus 201. So put it as an outflow like that. And we've that ticked off then. PP is explained. Intangible assets, we're told nothing else about intangible assets. So if we're told about amortization, which you'll deal with later on this semester in IAS 38, we'd put it in terms of a non-cash adjustment, it's like depreciation. Here, all we have is acquisition of, i.e. intangible assets, SOFP, minus 50. Because there's no other information, we can just assume you acquired 50 more intangible assets, gone from 200 to 250. You can do a T account if you wish, but because there's no other information, you just assume it's gone up by 50. It does get a bit more complicated when you have amortization, which we'll deal with in IAS 38 later in semester. It's essentially like depreciation, only for intangible assets. But for now, that's just a simple acquisition. You acquired intangible assets during the year, and you've dealt with that. And we've already actually dealt with the investments because we have put in the investments, you sold it for 30. It would have been debit bank 30, it's gone in here. Credit investments 25, which explains that. And as we've done above, it would have been, so down here, credit the P&L 5, which is your profit on disposal. So all those disposal moving parts have a lot of debits and credits you need to watch for. So we've dealt with all those assets now, current and non-current. So your net cash flow from investing activities is minus 189. We have another one complete. So what you do is you keep going on. Now you mightn't tot up these at the end. I just know we're finished here. For you, you might leave it at the end and make sure you have everything explained before you go on. For financing activities then, we're looking here at, for example, ordinary share capital and share premium. So we'll do a T account for this, and we're going to look at a share issue. And we'll look at working 6 here. We know it's a share issue because both of them have increased. And you usually look at them in the same T account, working 6. So I'm going to look at them combined because the transaction impacts the same accounts. So ordinary share capital plus share premium. So you look at them together. Sometimes you don't need to look, you can just look at the difference and you can save a lot of time. I'll just show you how to use these because they can be a useful skill to have for the harder ones. Balance brought down is 300. Balance carried down 360. So I'm adding the share capital and share premium together. So you clearly have had a share issue there, which would have been bank of 60. Debit bank, credit ordinary share capital, 50. Credit share premium, 10. So that is a share issue. And that is money into the bank account, which is a cash inflow. And that will go in financing activities. If you just said 360 minus 300, you get full marks. You don't have to use the T account the whole time. And you will pick up this the more questions you do. So share issue there, positive 60. A loan, be careful, this is a loan drawdown or a new loan. Loan drawdown is you're getting on a new loan. I just put there SOFP 120. That is positive because you're saying, well, the loan last year was 50, it is now 170. So the debit and credit there is debit bank, money coming in, credit loan, I owe extra money. That's another straightforward one we get out of the way. And the last one we're left with then is dividends paid, which we're going to look at as working 7. So remember, they tell us in the notes which they didn't have to. During the year end, 31st December 2014, dividends of 100,000 were debited to equity. So now, did we really need to be told that? Well, I can go down and prove that we didn't. We should have been able to calculate that ourselves, working 7. If we look at retained earnings, we can help explain the movement. So retained earnings, here are the opening balance and retained earnings. The opening balance and retained earnings was 100. The closing balance, the balance carried down, 160. So we need to explain how the retained earnings go from 100,000 to 160. 2 reasons. Profit for the year, which was 160 itself, which are given in the question, profit after tax. So that means if the company paid no dividends out, closing retained earnings should be the opening balance of 100 plus the profit for the year, 160. So it should be 260. It is actually only 160 at the year end. So you've paid dividends out, you've declared dividends of 100. That's where that's coming from in the notes of the question. Dividends declared is 100,000. It's not paid because, like we have in the example we looked at in week 2, we have dividends payable then. So there's 2 things you need to watch for. How much dividends are declared, which comes from retained earnings, and then how much dividends are actually paid, which comes from the liability of dividends here, dividends proposed. So we've explained retained earnings, we're happy enough with that, but how have we explained this? Dividends owed at the start of the year were 80, dividends owed at the end of the year were 100. So opening and closing. The only thing that moved that during the year was retained earnings. We declared dividends of another 100. So we should have had 180 owed at the end of the year if we paid nothing. We actually only owe 100. So we must have paid physically over to our shareholders 80 to balance it up, which would have been debit dividends proposed, credit bank. So it's a cash outflow. The amount of dividends paid to our shareholders in 2014, which will go to the statement of cash flows, is 80,000. And that thankfully explains that item. So we slot that in, working 7, minus 80. And your net cash flow from financing activities is 100. So if we look at the movement in cash and cash equivalents for 2014, we add the 3 of them up. 100 minus 189 plus 153. Thankfully, that is the 64 as per above. So you can prove that. The cash and cash equivalents are the 1st of January 2014, and then you do it at the 31st of December. This is a key disclosure requirement as well. First was minus 97, and at the end it was minus 33. We've calculated those. But to get your full marks for presentation, you must show those items at the end as well, where you show the opening balance, which was the minus 97, the balance at the end of last year, which is the opening of this year, and in the balance at the end of the year, which is improved by 64,000. Right, so that's important that you understand exactly where those figures are coming from and the steps involved. If you methodically explain each of the movements from the opening to the closing balance in every item, it should work out. Now, look, the odd time you're going to get an issue where you miss something or you make a mistake, it's not the end of the world if you have time to go back over it. But what we're looking for with a statement of cash flow question is nice and neatly laid out, showing the examiner where the figures are coming from, so cross-referencing the notes, and also then having neat workings where the examiner can follow your logic. That's going to be very important in any exam questions you do because there's a lot of workings in a statement of cash flows. So make sure now you go back over that question 5, which is Ben, and you'll see in the question pack there's a question 6, which is called mango, and question 7, which is called chestnut. Practice both of those for your week 2 as well. In week 3 onwards, then we're going to have tutorial questions, exam level questions on statement of cash flows as well.